anyways, needless to say, my account is down. This is a bit of a longer episode, and I'm just going to talk about changes in my plan and how I used to use a PE and a debt ratio to decide if I was going to buy a company. Obviously, some companies that I bought, let's say Home Depot for this particular instance. Home Depot's got a PE of 17 and a half for the sake of it. It's got a dividend yield, which I like, below 3%. Excellent. As it comes down, that yield goes up. Great, as long as they can continue to pay it. They do have a little bit of debt. This is okay. Same store sales are going down. I expect this company to have a reasonably poor year. Does that mean that it's a bad company? No. Does that mean that I want it in my portfolio? Yes, but that also comes with everything coming down. With interest rates going up, this is the first time that a person my age will experience this. 26, I know it says 25 and invested, but I am 26, and this will be the first, almost 27, this will be the first time that I've experienced interest rates going above, I think there are, in Canada, I think 3.5%, 4%. That's crazy. That's new to me, and I need to assess these companies differently because the market's different, and I need to evolve with that. Judging everything at a 22 PE and having low debt is just not the way that this story's going to go. Lately, I've been buying Dream Industrial Real Estate. I would like to continue to buy Dream Industrial Real Estate. They are quite down from their high of almost $18 down to $11, so they're almost bridging on 50%. Real estate REITs have high debt. That's just how they are. They give out majority of the money that they make to shareholders. So they acquire assets by issuing new debt or issuing shares. You're diluted by owning these companies. Does that mean that they're bad companies? No. Does that mean that I need to reassess the price that I want these companies at? Yes. And that's what this video is about. Basically, the idea of buying something when it's 30% down and then kind of averaging down from there is not going to work for the time being, especially as interest rates continue to rise. There will be more blood in the water, especially for companies. Ooh, yeah, I got him. Mosquito. Especially with companies that have a higher debt. That's just the math. I think the market's a little oversold right now. I do believe that we're going to see a reasonable bounce, but with the federal government in America trimming their balance sheets, and a lot of what I own is in America, the game has changed, and I need to reassess what I think is reasonable. That's why I'm going to start buying when companies are 50% down. Good companies are 50% down. That does not mean that I personally am going to sell anything that I have acquired already. I still have a cash holding. That cash holding still about 30% of my portfolio. I'm adding money to it, but I'm not buying anything yet. And that's important. It's important to have that savings there. It's important not necessarily to play a waiting game. Time in the market beats timing the market every time. But we're going to experience a prolonged time of increased elevated interest rates. And those interest rates seem like a better safe haven than stocks. And as long as that's the case, then stocks will perform poorly. They are performing poorly. They say that when Apple, falls, that's like the straw that breaks the camel's back. That's when we know that everything's going to Apple. My Apple position at 140 is down $15 a share. It's not much, I only have $2,000 in Apple. $1,800 in Apple. But, I expect Apple to come down quite a bit. Right now, their PE is 21. I have to reassess that. They have low debt. Fantastic. They have a high PE now. 21. am I waiting? Should I jump in at a 14 PE? We'll see what interest rates look like by then. If inflation starts to get under control, or let's say that inflation starts to slow but not, say it starts to slow year over year but not like resolve itself, that's when I'll start buying. Right now, interest rate is still spiraling out of control, and I want to be early to the stock buying. I want to make sure that when I start buying stocks, there's still some downside. I'm not going to catch the bottom, but I just want to be realistic and be advantageous to a market and how it's changing. Right now, it's changing daily, which means it is very hard to judge these things, and it is hard to jump in and out. But I think that it's worth it right now for me to wait on that other 30% of my cash to see what the government's going to do, see what interest rates are going to do, see how housing's going to do. Like, there's all these uncertainties in the market, but that does not mean that I'm selling anything that I already own. That money's in. I acquire shares. I don't sell. Personally, the companies that I'm buying, I want to hold forever. That's the reason why it's so important for me to buy at such a good price, because my expectations of these companies need to be high. Because if they're not high, then there's no point in buying these. I could just buy bonds for 4 or 5% right now. Anyways, guys, that's that's me. That's what I'm doing. A little update, a little longer of an update. Just want to talk about Apple and Facebook and reevaluating shares with an increased interest rate. I got my point across. Anyways, guys, this is it for my I am going to continue to do little updates every time I chip in and buy stocks, or weekly updates. But right now, I'm on true hold to see what the market does, to see what the federal government does in Canada and the U.S. I do follow the U.S. a little more. Maverick of Wall Street follows the U.S. and Canada mimics the U.S. I know we're not exactly the same, but God, we're pretty close, aren't we? Anyways, guys, I'll see you next time. Bye.